Hello guys. In this knowledge module, we'll talk about the relationship between the prices and the exchange rate. So we have a learning objective where we'll see that how the price level and the change in the price level means inflation in different countries determine the exchange rate of their currencies. In doing so, we will learn about two economic theories, and one is called the absolute purchasing power parity and other one is called the relative purchasing power parity. There are few economic theories which are unique to the field of international financial management, which links the prices, the change in the price level, interest rate, and the exchange rate. And these economic theories are called the international parity conditions. For this knowledge module, we will only stick to the theories which link the exchange rate and the prices or the change in the prices of goods in different countries. First of all, we need to know about law of one price. The law of one price says that if there is an exact same product or identical product and it is getting sold in two different countries, once the price of that product will be converted into a common currency, the price should be the same of the price of that product should be the same irrespective of the market where it is getting sold. And in case of the international financial management, we mean to say that does not matter which country it is getting sold, the price of the product should be the same if converted into a common currencies. But there are heavy assumptions or there are big assumptions attached to it. For example, there are no tariffs, there is no transaction cost, product can be freely moved between the borders, and we know that these issues, these assumptions are mostly violated, and this is the main problem with the law of one price. But given the assumption that if there are no market frictions, borders can be freely moved from one place to another, or it can cross the border, there are no quotas, there are no tariffs, there is no transportation cost, then yes, the law of one price will hold. Now, for example, if these market frictions are not there and the assumption holds, in that case, say in USA there is a product A whose price is $10, and for the same product the price in Japan is 1000 yen. From here we can find out what is the exchange rate. Then in that case the exchange rate S should be the 100 yens per US dollar. So this is the base currency per US dollar, this is a quotation, and this is 100 yen, right? So if you simply divide 1000 yen by $10, we will get the exchange rate. Unfortunately, the law of one price does not hold for all the goods, and this is an issue. For example, the Canada, it's an agriculture country. Over here, the agriculture product are more likely to be sold like the cost of the agriculture product is more likely to be low compared to Japan. On the other hand, the PlayStation is most probably in Japan, it is manufactured in Japan, it must be available at a lower cost. So for example, if the Apple in Canada, the same Apple is costing $2 and in Japan it is costing $400, then if we want to infer the exchange rate, we can see that in order to buy 1 unit of Canadian dollar, so where the Canadian dollar is the base currency, we need 200 yens. So is this the exchange rate? Now, another example is the PlayStation 4. In Canada, its worth is 250 Canadian dollar. In Japan, it's with the same specs, its worth is 35,000 yens. So if we will try to infer the exchange rate from here by dividing 35,000 with 250, we'll see that the exchange rate turns out to be 140 units of yen in order to buy 1 unit of the Canadian dollar. So this is the base currency Canadian dollar, and this is the price currency yen. So at a single point in time, only one exchange rate will prevail. Then if there are two exchange rates, it shows that there is some issue. Some product, even they are same product, they might be getting sold at a different prices in the two countries, and there might be many reasons, as I mentioned in the previous slide. For example, there are market frictions. So markets are not efficient. There is a transportation cost. There are sometimes there are quotas available. There are tariffs applied in order to safeguard the domestic industry. So law of one price usually gets violated. In order to find out the exchange rate, we need to relax some assumptions. So one of the assumptions which we are going to relax in absolute purchasing power parity. So once the law of one price, people saw that it is not explaining the exchange rate very well, they moved ahead with the relaxed assumptions. So the relaxed assumptions are that we talk about rather one identical product, we talk about a basket of consumer goods, and we'll say that yes, the individual product, the law of one price for the individual product within the basket might not hold, but the law of one price can hold for the overall basket. So for example, there is a consumer basket of consumer good in which we have, say, apple, toothpaste and tissue paper. Now in Canada, if the apple toothpaste and tissue paper price is $2 per unit, and for the toothpaste it's $5, and for the tissue paper it's $3, and in Japan it's 400 yen for the same apple, for the same toothpaste it's 500 yen, for the tissue paper it's 200 yen, then if we will try to find out the exchange rate, we again will get three different exchange rates. And again, it does not make sense, because at a one point in time there is only one exchange rate present. If you go to the international trade foreign exchange market, you will find and observe that only one exchange rate is there. So if you can see that for the apple, if from the same apple, if you try to drive the exchange rate between the two currencies, the Canadian dollar and Japanese yen, we'll see that there are 200 yen for each like Canadian dollar. The according to the toothpaste, like if we'll go and try to convert infer the exchange rate from the prices of the same toothpaste in these two countries, then the exchange rate should be 100 yen to buy 1 Canadian dollars. For the tissue paper, it turns out to be 66.67 for 1 Canadian dollar. Now there are three different exchange rates coming out from the three different consumer goods present in this basket. So we do not talk about the individual consumer goods in the absolute purchasing power parity, because of the violation of the assumptions, assumptions of transportation cost. There is always a transportation cost, there is quotas, there are tariffs. So we talk about the overall basket, and we say that okay, the individual goods, the same goods even do not get sold at the same price in the two different countries once we convert their prices into a common currency. But at least the overall basket, once we'll buy in one country and another country, the price of the overall basket of the consumer goods, which in this case is apple, toothpaste, tissue paper, will price the same once we convert the price of the basket into a common currency. So if person have $1 and he's sitting in Canada, remember these are not US dollar, we are going with the Canadian dollar example. So he can buy the same apple, toothpaste and tissue paper in Canada, and if in Japan the person has 110 yen, he will buy the same goods, the basket of goods uh, in Japan with 110 yen. That's why the exchange rate is 110 yen per Canadian dollar. And how did I get it? I added up all the Japanese yen prices, I added up all the Canadian dollar prices for these units, and divided 110 1100 yen divided by the $10, and this is how I got this exchange rate. So this exchange rate will prevail, rather these exchange rates which we inferred from the prices of the individual goods. Now the absolute purchasing power parity states that the spot exchange rate is determined by the relative price of the similar basket of goods, what I just mentioned over here, this thing. It will not be determined by the exchange rates inferred from the prices of the individual goods, but the overall basket of consumer goods. Over here the example is very simple. I included only 3 items, but in a true when the true basket of consumer good is is considered, that will actually drive the the prices of that consumer good in different countries will drive that what should be the exchange rate. Now one of the very popular basket is called the Big Mac index, and it is developed in 1980s by the economist. Why the Big Mac is index is the popular? In order to determine whether the absolute purchasing power parity holds or not, because first of all, Big Mac is the burger which is introduced by the McDonald's, and the McDonald's standards are very consistent and uniform. So it does not matter which country you go in, you will get the same Big Mac. Second, the items or the ingredients which make the Big Mac, it reflects the domestic prices, because most of for example lettuce, mayonnaise, which is the ingredients from which the Big Macs are produced in any country, those ingredients are bought from the local country. So the ingredients prices reflect the domestic prices, and this is what we want to measure. If we are comparing the price of the Big Mac in China with the price of the Big Mac in USA, the ingredients and try to see that whether they are the absolute purchasing power parity hold, then it means that in this basket of Big Mac, whatever are the ingredients, they are acquired or domestically, and the domestic prices is making up the price of overall Big Mac, and then we'll try to compare. So if say the Big Mac price in USA is say $1 and in China it's 10 yuan, then ideally the exchange rate should be 10 yuan per US dollar. So there should be 10 yuan units of the Chinese currencies. We needed to buy 1 unit of the US currency ideally. Now let's see whether the absolute purchasing power parity holds when we consider this basket of Big Mac, because again the Big Mac is the basket in this case. So this is a table, and I think this is from the March of January 22nd March, and if you see that the US United States, the price of the Big Mac in US is 4.79, and the price of the Big Mac in US and the price of the Big Mac in China is 17.2 yuan. So this shows that ideally, according to the absolute purchasing power parity, what should be the exchange rate? You simply divide 17.2, which is the price of the Big Mac in the China, this one, with 4.79. So if I'll do it, I'll get that the implied purchasing power parity exchange rate, this one, fourth column, should be 3.591, right? So this should be the exchange rate if the absolute purchasing power parity hold, right? When we saw the actual exchange rate, it turns out to be 6.2115. So what is the issue? We can clearly see that the absolute purchasing power parity theory to determine the exchange rate is not holding, right? So we can see that in the exchange market, foreign exchange market, you need to pay more units of yuan in order to buy 1 unit of the US dollar. So which currency is overvalued and undervalued over here? Just pause and try to think about it. I think so you have been able to figure it out by this time. It clearly seems that the yuan is undervalued and US dollar is overvalued, because the theory suggests that the 1 unit of US dollars should be equal to 3.59, because once you divide 17.2 yuan with the 4.79, this is the exchange rate you will get, which is called the implied purchasing power parity exchange rate. 3.591 units of yuan in order to buy 1 unit of the US dollar. But the actual exchange rate is 6.2115 yuan. So you are paying more yuan compared to the theory in order to buy 1 unit of the US dollar. So the yuan or the Chinese currency is actually undervalued. You have to pay it more compared to the theory. And obviously when one currency is undervalued, automatically it means the other currency is overvalued. And whenever the overvalued and undervalued figures come to your mind, overvalued, you try to attach it with the positive sign, and the undervalue, you try to attach it with the negative sign. So if the yuan is undervalued, by how much it is undervalued? So if undervalued is attached with the negative sign, then try to subtract the big number, the big exchange rate number, with the small exchange rate number, and divide it with the exchange rate number, which is you have included later on in the formula. So 3.59, not the later one, 3.59 minus 6.2115 divided by 6.2115, you will get minus 42.2%. So this calculation is also given on the other slide. All these things on the slide I have discussed in the previous slide, but just verbally. So we can see that the US dollar is overvalued and the yuan is undervalued. So in order to get this number, the undervalued is, as I just mentioned, should be attached with the negative sign, should be associated with the undervalued. So in order to get the negative sign, you need to subtract the bigger number in the numerator from the smaller number. So 3.591, which is the implied purchasing power parity exchange rate, minus 6.2115 whole divided by whatever is the second number, this one. You again have to include it over here, and whatever the number you will get, that will be in decimals. If you will multiply it with 100, you will get 42.19%. So the yuan is undervalued by 42.19% compared to versus US dollar, and according to the purchasing power parity, absolute purchasing power parity theory. And by how much US dollar is overvalued? Again, the overvalued should be associated with the positive sign. So subtract the small number by the big number, and whatever is the last number, you need to bring it in the denominator. You'll get something in the decimals. If you will multiply that decimal with 100, you will get the percentage, which is 72.97%. So what does it tell you? Whether the theory is wrong, the absolute purchasing power parity theory is wrong. The main thing is the interpretation of the theory. Theory is not wrong. The theory suggests that in the long term, what like how these pair of currency will likely to move. Because the yuan is undervalued, so the value of yuan will increase, and because the US dollar is overvalued, the value of the US dollar will decrease. So this is mentioned by the absolute purchasing power parity theory in this situation. So the theory of purchasing power parity is supposed to indicate that the value of currency should go where, like the value of where the value of the currency should go over the long term, and not necessarily its value today. So theory is not wrong. Theory is just giving a direction that where in the long run the US dollar will move. Yes, the US dollar will go down. The actual rate was 6 point something, and it should be 3.5. So it should go down from 6 point, like I think 6.2 to 3.5. So it should go down. It means once it will go down, it means that the US dollar will going to be will move to the exchange rate which is implied by the purchasing power parity, or the value of the US dollar will decrease. And once the value of US dollar will decrease, it automatically means that the value of the yuan will increase. Now, because there is an issue, we are not able to find out through this theory that what should be the exchange rate today. We are not able to predict the today's exchange rate with the absolute purchasing power parity. So we need to relax some further assumptions. In the long run, the theory is going to give us a hint that where these the prices will move for these two currencies, that the US dollar will basically decrease in value and the yuan will increase in value, but it is not able to predict the today's prices. So we need to do some further, or relax some further assumption. So when we start relaxing the further assumption, we comes to another theory which is called the relative purchasing power parity, and it involves the inflation differential. That what is the difference of inflation between the two current countries? For example, if in USA the inflation is 10% and in China the inflation is 6%, then what is the difference? The difference is 4% of inflation. The inflation in USA is more, it's 10%. In China it's less, it's 6%. So if the 4% inflation is more, then where there is more inflation, the currency of that country will depreciate approximately by the same 4% compared to the other country. So let's move ahead and see what the relative purchasing power parity theory tells us. So here we accept in relative purchasing power parity, we accept the actual exchange rate as it is, like where they are standing right now. But like we suggest that the exchange rate will change over the period of time due to the change in inflation in one country relative to the other countries. So the relative PPP holds that the purchasing power parity is not particularly, like the simple absolute purchasing power parity is not helpful in determining the spot rates today, but the relative change in prices between two countries over a period of time determines the change in the exchange rate over that period. So in other words, that we accept the exchange rate today as it is, but we'll say that the change in the exchange rate depends on the inflation of one country relative to the inflation in another country. So if the spot exchange rate between the two countries starts in the equilibrium, any change in the differential rate of inflation between them tend to be offset over the long run by an equal but opposite change in the spot exchange rate. Maybe it's difficult for you, but with this example might be you'll be able to understand in a better way. So say in Japan, which is a foreign country, the inflation is 4% lower than the USA. And the spot exchange rate of the yen versus USA, then we will expect to increase by 4% per annum at point P. So look at this figure over here. So this line, which is the x-axis, this is the percentage difference in the expected rate of inflation foreign relative to the home currency. So if if USA is the home currency and Japan is the foreign currency, and in USA the interest rate is 6%, inflation is 6%. So, and in Japan the inflation is 2%. So what does it mean? Where there is less inflation? Obviously in Japan, 2% minus 6% minus 4%. So minus 4%. We are standing right now over here. The relative purchasing power theory suggests that if whatever is the differential interest rate, differential inflation rate, the currency will the foreign currency will change in the opposite direction. If there is the differential inflation is -4, then its currency will likely to appreciate by 4% compared versus the US dollar. So this line is suggesting the differential inflation rate of Japan, this one, and this one x-axis is suggesting the percentage change in the spot rate of the Japanese yen versus the US dollar. So if in Japan the inflation is 4% less, means we are standing over here, then the yen will likely to appreciate by 4% versus the US dollar. So this appreciation will come over here, 4%, and this will be the next equilibrium. So over this line, which is making the 45-degree angle, we will remain in the equilibrium. But if say in Japan the inflation is 2% less compared to the inflation in the USA, and if its currency appreciate by 4%, it means that the Japanese yen become overvalued and the US dollars become undervalued, so it's become a weaker currency. So this is over at point W. Weak means that the home currency is the weaker currency, because the foreign currencies, which is the Japanese yen in this case, become overvalued. And if you come over here, it means if the inflation in Japan is 4% less compared to the inflation in the United States, in that case, if the Japanese yen appreciate by only 2%, somewhere over here S, it means that the Japanese yen becomes undervalued versus the US dollar, and US dollar become overvalued. That's why the domestic currency, which is US dollar, is the stronger currency over here. It's a strong point. The logic behind the purchasing power parity is, if there is a high inflation in one country, it means its products become expensive for the export purposes, right? And if the exchange rate will not move, so for example, if one country has more inflation and if its exchange in the its currency will not depreciate, it becomes expensive for the importers to buy from this country. So the country's export becomes less competitive versus its trading partners. So in order to keep exporting, it is mandatory for a country where there becomes higher inflation to that its currency should depreciate, and it should offset the difference of the inflation between the two countries, like what we have seen earlier in the example of the USA and Japan. Therefore, the currency should devaluate for the this is the last point. Therefore, the currency should devaluate for the country where the inflation is high in order to keep its export competitive in the global market. So It's very simple. If in a country there will be the things become more expensive, why the trading partner should import from this country? Why should, if the things are available cheaper in their own country or in the other countries compared to USA? Because we are giving over here the example of USA, and USA inflation is high compared to the what is the inflation in the Japan. Likewise, where there is an inflation, its own people, their citizen of their own country, will start buying from the abroad, because they can simply give the same number of units to buy one unit of foreign currency and buy from the abroad where the prices are less. The only way things will come into equilibrium if the domestic if the country where there is more inflation, its currency will depreciate, and you have to pay more units of their currency in order to buy the 1 unit of the foreign currency. So in other words, in order to remain competitive in the international market, the currency of the country where there is a higher inflation should depreciate and offset the difference of the inflation between the two countries. There are many empirical tests conducted on the purchasing power parity on both versions, and unfortunately, purchasing power parity does not prove to predict the future exchange rate. The underlying assumptions are mainly violated, and this was the reason that we did not get substantial support for these theories. However, from the extant literature, there are two main conclusions. One is that the purchasing power parity, it holds well over a very long period of time, but poorly for the shorter period of time, and also it holds better for those countries where the inflation is relatively high, and those are usually the underdeveloped capital markets. Finally, the exchange rate pass through is an important concept. So if there is a change in the exchange rate, maybe because of the inflation, if that change in the exchange rate is fully reflected in the in the prices of imported and exported goods, then we say that there is a complete exchange rate of the pass through. So for example, if there is a car which is getting manufactured in Germany and it costs 50,000 euro, and right now the exchange rate is the $1 per euro. So this is not a quote, this is a mathematical way of writing the exchange rate. Then the imported price is $50,000 for the same car. Now if the exchange rate changes and now you need to pay 1.2 units of US dollars to buy 1 unit of euro, then in that case the price of that imported car in USA should be $60,000. So simply multiply this 50,000 euros with the new exchange rate, you will get 60,000, right? So we can see that the euro has appreciated by 20%, because when it went from 1 to 1.2, so the price of the euro increased by 20%, right? So 1.2 minus 1 and divided by 1, you will get 20%. Likewise, the price of the car in USA also increased by 20%. In Germany, it did not increase because like it is the domestic currency, and the euro, it is getting manufactured in Germany, and its price remained 50,000. But actually, the only issue is that once it is imported in USA, and because the euro become appreciated, and this 50,000 euro car is now worth of 60,000 in USA. in that case you can see that 60,000 minus 50,000 US dollars divided by the 50,000, you can see that there is a 20% increase of the same car in USA. Now the manufacturers sitting in Germany are concerned, and they are saying, wow, the change of the exchange rate by 20%, there was a 20% appreciation of euro, if we'll let its affect, like if the impact of this change in the exchange rate will go in totality into the prices will also increase by 20%, and that is a huge increase. They are concerned that the price, the demand of their product, their car will decline. So they said, rather increasing the price to 60,000 US dollar, let's increase it to 58,000. So this is increase of 16%. So $58,000 minus the previous $50,000 and the divided by the $50,000, you'll get 16% increase in the price. So even though the exchange rate increased by 20%, but the price increased by 16%. So the effect of the change in the exchange rate is not totally reflected in the import prices. So this is called the partial pass through, or the partial exchange rate pass through. The goods which are whose demands are elastic, for example, whenever there is a percentage change in the price and the percentage change in the quantity demanded, this is the formula for the price elasticity of the demand, where you need to divide the percentage change in the quantity demanded with the percentage change in the price. If this is greater than 1, it means with the little bit change in the price, there is a huge there is more impact on the demand of the quantity. And if this percentage change in the quantity demanded is more than the percentage change in the price, then such the goods are elastic. So normally the goods which are highly elastic, we usually observe in that case the partial exchange, partial pass through of the exchange rate, and the goods which are inelastic, we usually observe high degree of exchange rate pass through. So we know that these inelastic goods does not matter how much prices will change for these goods, people will still buy those goods. For example, petroleum product, when the petrol is in demand, you need to does not matter if in the global market the prices of the petrol will go up, and if it will go up, people will still buy it. This product is relatively inelastic. So in that case, if the exchange rate changes, normally the effect of the change in the exchange rate is totally reflected in the imported into the price of the imported or the exported petroleum product.